Hello friends. So today we are going to do mock test number 5 of BFM, that is called Bank Financial Management of CAIIB. So in this we are having 20 questions and some of the questions are case study based. So you also solve along with me and you should not take more than 20 minutes. And I'll be giving some explanations so that you can check your answers also. So here is the first question. This question is based on case study. So Apex Bank has a repo transaction. The detail of it has been given below. Type of security is Government of India. Residual maturity is 5 years. Coupon rate is 6%. Current market value is rupees 3000. Cash borrowed is 2000. Modified duration of the security is 3.6 years. Assumed frequency of margining is daily. Haircut for security 1.4%. Haircut for cash is 0. Minimum holding period is 5 business days. Change in yield for computing the capital charge for general market risk is 0.7% per annum. So here the first question, calculate the capital charge for CCR, means counterparty credit risk. What is the capital charge for the counterparty risk? So for calculating the capital charge for CCR, we are going to use the formula of haircut. Means we are going to take the help of the formula haircut. First of all, we have to write the values. We have to understand what values are given here. So maturity value of security, they have given 3000 because bank has given its security to the lending party. Okay, so that they have borrowed the cash of, they have taken the cash of 2000. Okay, now so exposure of 3000 rupees is there. CCF means credit conversion factor for exposure is 100% because it's government security. So on balance sheet credit equivalent will be 100% of 3000. So we are getting 3000 here. Haircut they have given 1.4%. So that means we are going to calculate what is the exposure here. So 3 into 1 plus HE. So 1 plus HE means 1.4%. So we'll be getting 1.014, 1 plus. Because 1.4%, so 0.014 and plus 1, so 1.014. And into 3000, so we are getting 3042. So now we got the value of this E cross 1 plus HE. Now, collateral for security lent cash. So cash has been taken by the bank, so it is 2000 rupees. Haircut on cash is 0%. So now we are going to calculate C into 1 minus SC. And HFX is not there because this currency mismatch is not here. So it is 0. SC is also 0. So 2000 into 1 means 2000 we are getting here. So what is net exposure? That means from this value E into 1 plus HE, we subtract C into whatever value we got here. So 3042 minus 2000, we are getting 1042. So this is the next net exposure bank is having. Now, risk weight for this type of activity, this schedule CRAR compliant bank is always 20%. Okay. So what is risk weighted asset? So net exposure into risk weighted asset 1042 into 20%. So we are getting 208.40. Okay. Now, as per Basel norms, what is the capital charge? Capital charge is 11.5%. Okay. So 2008.4 into 11%. So we are getting here 23.97. So capital charge for CCR means counterparty risk is how much we are getting here? 23.97. So 23.97. So option 2 is correct here. Now second question, data is same here. Only thing is that calculate capital charge for credit risk. capital charge for credit risk. Because it is a government security, so credit risk will not be there. So we are getting here 0 answer. Okay, so option 1 is correct here. Now question number third, capital charge for market specific risk. Okay, so capital charge for the market specific risk here. So again, because it is a government security, and if it is security is held under for sale and held for trading. So being government security, the market means market risk is not there. Condition that it is available for sale or held for trading. So market risk is not there. Now moving ahead, question number fourth, calculate capital charge for market general risk. Okay, now capital charge for the general risk. In question number third was the specific risk, and now here the capital charge for market general risk. Okay, so for this we are going to use the formula here. You can see it's very important formula. You can make the noting of it. Capital charge for market general risk to modified duration into assumed yield change percentage, mean in percentage what is the yield change is there, and market value of the security. So market value of the security we know 3000 is there, and modified duration it is given the question 3.6, and yield change is 0.7%. Okay, so multiply here means 0.7% means you divide by 100. So we get here 75.6 here. So answer is third is correct here. Okay. Now question number fifth here. Data is same but calculate total capital required. Okay, so total capital required means whatever we have made the calculation, only we have to add all these four. So CCR was 23.97, credit risk 0, market risk specific was 0, but general market risk we got 75.6, so we have to add. So 99.57 is the answer. So 99.57, that means option number 4 is correct here. Now question number 6. Now these are the concept based question. The features of exchange traded product are. So what are the features of? That means the product which are traded in exchange, what is the feature? The contract is for the standard size is correct. Delivery dates are fixed is also correct. Price fluctuation according to the market. So these are also correct. We might have seen the exchange trading. So contract size is fixed, delivery dates are fixed, and price fluctuation according to the market. So all three are correct here. That means option 4 is correct here. Now, seventh question also concept based. According to Reserve Bank of India policy of investment and risk should be supplemented with. So prevention of money laundering policy. Number 2 option, hedging policy for customer risk. So according to Reserve Bank of India, the policy of investment, the risk should be supplemented with prevention of money laundering policy and hedging policy for the customer risk. Both are correct here. You must go through this policy of investment. It is very difficult. So, but for this question, both options are correct here. Okay. Now, question number 8. What are the RBI guidelines for development of interest rate swaps? IRS we call in short. So what are the RBI guidelines for development of IRS? Bank can use IRS for hedging and trading both. Mumbai Interbank operates a benchmark for IRS. Under ISDA agreement, bank can opt for dual jurisdiction, that is the Indian as well as common law. Okay. So options, if we see the options here, bank can use IRS for hedging and trading both. Yes, correct. MIBOR means Mumbai Interbank Offered Rate is a benchmark for IRS is also correct. Under ISDA agreement, bank can offer dual jurisdiction, that is the bank Indian as well as common law. So all three are correct here. What is full form of ISDA? So ISDA is International Swaps and Derivative Association. So all three options are correct here. Now question number 9. Choose the wrong pair from the following. The information given in the pair is pertaining to banking companies. So number 1 option is reserve and surplus, share premium, time deposit, mature time deposits, borrowings in India, refinance from NABARD, other liabilities and provisions, inter-office branch adjustment. Okay, so in this you have to calculate which is mismatch, that means which is wrong pair here. So you have to see what is the wrong pair here, means time deposit, matured time deposit. Okay, means if you see other options, how these options has been defined. Okay, that like share premium will go as a reserve and surplus, refinance from NABARD will go as borrowings in India, and inter-office or branch adjustment will be other like other liabilities and provisions. Only thing is that how mature time deposit will be converted to time deposit. Okay, so this is the wrong pair. Okay, now next, an LC which authorizes the adjusting bank, not sorry, advising bank. An LC which authorizes the advising bank to transfer at the request of the beneficiary. Okay, it being the first beneficiary, the credit available in whole or in part to one or more other beneficiary, second beneficiary, is known as. Okay, we must know the LC is transferred only once, but it can be transferred to more than one beneficiary at one time, means second beneficiary. So these type of LCs are known as transferable LC. Okay, now next question. Which of the following is a distinct feature of future contract? So we have to see here what are the features of future contract. The contract are marked to market daily. Yes, correct. The members are required to pay margin equivalent to daily loss. Is correct. In case of default by any member, the exchange will meet the payment obligation. Is also correct. So that means all three features are correct here. Now question number 12. The composite risk policy under treasury option should include the following. Here is the composite risk policy under treasury operations should include the following. Number one, norms for merchant and trading positions, security trading, and exposure limit. So that means all three options are correct here regarding the treasury policy. Okay. Now next, that means option 1, 2, 3. Option 1, 2, 3 means norms for merchant and trading positions and securities trading and exposure limits. All are correct regarding the composite risk policy of treasury operation. Okay, next question 13. Now again this case study based question has come here. We have to see the data first. You are working as a middle level executive with Strong Bank Limited is the name of the bank. The MIS department has submitted. MIS department is Management Information System. Department has submitted the following statistics from which you are required to estimate the likely capital fund required by the bank as on March 31st, 2020. Taking into account the Basel III implementation compliance. Okay, what the data they have given here? The risk weighted asset for credit risk likely to be rupees 53,889.50 crores. This is the risk weighted asset. Capital allocation for market risk is to be rupees 100 crores. For operational risk, the following data available. The operational risk they have given the 3 years data, that means 17, 18, 19, 26,000, 3,000 and 34,000 crores. Okay. Based on the gross income given above, likely capital charge for Strong Bank Limited as on March 31st, 2020 to cover the operational risk under basic indicator approach. This is the main point here. They are asking the capital charge as per basic indicator approach. Okay. So as per basic indicator approach, we have to see the formula here. That means we have to take the, and which year they are taking for the operational risk. Operational risk data is given here. That means for year 17, 2,600, for 18, 3,000, and for 19, 3,400. Okay. So as per basic indicator approach, first we have to take the average of this value. Okay, that means 2,600 3000 and 3400. So we have to take average of all these values. So you add and divide by 3. So we are getting 3000 here. And as per basic indicator approach, it is the 15% of the whatever the value is we are getting here. Okay. So whatever the average gross income for the last 3 years, we have to take the 15% of the value. So we have taken the 15% of 3000. So we are getting 450 crores here. So answer third is correct. Now next 14 question. Data is same here, but what calculation we have to do here? The strong bank limited will require the total capital fund for covering credit risk as on March 31, 2020 to comply Basel III norms. Okay, so capital fund for the credit risk, we have to see where the credit risk is there. So credit risk value is given here. Risk weighted asset for the credit risk is 53,889.50. So now see the calculation here. This is the risk weighted asset is given here. So credit fund covering for credit risk will be 9% because this already RWA is given here. So we have to take the 9% of 53,889.50. So if we calculate and round up, so we are getting 4,850 crore. So option second is correct here. Okay. So 9% we have taken here. So we got the answer 4,850 crore here. Now 15 question again, concept based question. Which of the following is oblique are correct regarding open position in forex? Number 1, position limit are prescribed currency wise as also for aggregate position in rupees. Number 2, there are separate limits for day, light and overnight. Okay, so you have to tell me which options are correct here. So option both are correct here because position limit are prescribed currency wise and also for the aggregate position in rupees, and there are separate limit for day and overnight. So both the options means correct, means both first and second means option fourth is correct here. Now again question is concept based. Which of the following statement is not correct? Okay, so you have to tell me which statement is false. Credit risk may arise on account of default of the issuer or borrower. Rating migration may not cause credit risk. Deterioration of credit quality of the instrument have adverse impact on the price of the financial instrument. So you have to tell me which is not correct. Okay, so first option is correct because credit risk may arise on account of default of the borrower. Rating migration may not cause credit risk. This is wrong statement. So rating migration may cause the credit risk. Okay, so option 2 is correct here. And now question number 17. An amount up to USD, mean United States dollar, can be repatriated every year out of balances held in NRO account for permissible transactions. So this is the direct concept based question. So 1 million can be repatriated out of NRO account every year out of India. So this point you have to keep in mind, 1 million USD dollar. Okay, so 1 million is nothing but it is 10 lakh rupees. Okay, sorry, not rupees, 10 lakh USD dollar means 1 million means 10 lakh. So USD is given here. So option first is correct here. Now next question 18. If a dollar N transaction takes place between bank A and bank B in Mumbai, so dollar is from US and N is from Japan. So but transaction is taking in Mumbai. It will give NSE to settlement risk for only bank A. It will give rise to settlement risk for both the bank A and B. It will give NSE to settlement risk for bank A or bank B. It will not give NSE to settlement risk. All statement are not correct here. It will give settlement risk for both bank A and B. Okay, because bank both and will have the risk of settlement because bank A is dealing with the dollar and bank B they're dealing with yen, so must be located in US, and bank B must be located in Japan. And settlement is taking in place in Mumbai, so they are having settlement risk. Both are having settlement risk because they are dealing in Mumbai. Okay. So now question number 19. The following limit in treasury are meant for controlling market risk: counterparty interbank exposure limit, settlement and pre-settlement limit, intraday overnight open position limit and stop loss limit, overseas borrowing limit prescribed by RBI. If you read the statement properly, so following limits in treasury are meant for controlling market risk. Okay. So counterparty is not there, settlement is not there. So intraday overnight position and limit, stop loss limits, they are the limits in treasury meant for the controlling the market risk. So option third is correct here. Now, last question of this. What is ISDA master agreement? So ISDA stand for, means what is the full form of ISDA? International Swaps and Derivative Association. So first option, it is standardized agreement formulated by International Swaps and Derivative Association. This is correct. Number second option, the agreement has been approved by FEDI. Okay, so this agreement has been approved by FEDI, Foreign Exchange Dealer Association of India. So that's been approved by FEDI. Master agreement, means third option, master agreement covers all transactions between two counterparties globally. So all are correct here regarding the ISDA. So option 4 is correct here. Okay. So with this, we'll finish our video, and keep watching my next video. We'll upload more questions here so that you are benefited. Thank you very much. Have a nice day. Good day.